Welcome to this class on financial performance measurement. This is the first class on these topics, and in particular today we'll provide an overview of the financial statements. So financial statements are the documents that report the information about the project in an organized and synthetic way. And they describe the relationships between assets, liability, revenues, and costs for a project. And in doing that, they represent the basis for financial evaluation. So clearly, when we talk about financial evaluation, as we explained in the previous classes, we are talking about projected financial statements or pro forma financial statements that are based on our expectations about the project. So today, our outline is about introduction to financial statements. That is the first point we'll deal with in this class. Then we'll analyze the three different documents, three main documents that are included in financial statements, that are income statement, balance sheet, and cash flow statement. So we'll start from an introduction to financial statements. In particular, we'll see that financial statements include three main documents that are the ones that I was mentioning before, that are income statement, balance sheet, and cash flow statement. The income statement, as we'll see in this class, report the results of a project in a given period, where for results of a project we mean the net profit equal to the difference between revenues and cost, net of taxes. So the income statement is built on the basis of the accrual method. That means that costs and revenues are registered in the period when they are incurred independently if in the same period they are financially transacted. So this we'll see is the main difference that we have between income statement and cash flow statement. Then we have the balance sheet. The balance sheet is a snapshot or a picture of the assets and liabilities of a project at any given moment in time. And instead the cash flow statement that is derived by the two previous documents is a statement that reports the inflow and outflow, so reports the movement of cash generated by the period for each period. And the difference between the cash flow statement and the income statement is that as I was saying before, the cash flow statement reports the movement of cash, whereas the income statement based on the accrual method reports revenues and costs, even if they have not generated cash flow movements. So then in this class, we'll look in more detail at each of the documents that are mentioned in this slide. Okay, so let's start from the income statement. Here we report an example of income statement that we'll analyze. However, before looking at the example, I would like to make some initial remarks. First of all, as I was saying before, the income statement is based on the accrual method, so this means that revenues and costs that are reported in the income statement are incurred in the period to which the income statement refers, but in the same period they have not necessarily generated a financial flow. And this is particularly evident in the case of depreciation, because as we know at this point, depreciation is an accounting item that signals the loss of value of a fixed asset, but that does not generate any cash flow. So we'll find depreciation in the income statement and will not find, for example, depreciation in the cash flow statement. Another difference here is that other financial transactions, like, for example, the repayment of principal of a debt, not being a cost, are not reported in the income statement. So the income statement is different from cash flow statement for these two reasons, because it reports costs that probably have not been translated into a financial transaction and does not report instead financial transactions that have not generated a cost for the period. So in general, income statement is useful for the calculation of taxation, as we'll see in this example, is taxation are calculated on the basis of cost and not of cash flows. The second aspect I would like to remark is that clearly when we are evaluating a project, the income statement is a projection. So for each year of the life of a project, we'll have projections about revenues, cost, and so on. And so we'll have a projected net profit for the project in each year of the life of the project. So in preparing the income statement, we have to make predictions that are based on the nature of the project, on the expectation about the market, the economic cycle, and all the considerations that are needed for making reliable projections. So say that, let's look at this example of income statement. This income statement can refer to a generic year. That year is indicated as 2XX. That could be 2012, for example. So this will be the income statement projected for this investment for the year 2012. The first line that we can see in this income statement is the revenues that are generated by the project in that year. And then we start including the costs. So the first costs that are included in this income statement are the variable costs, where for variable costs we mean those costs that proportionally change with revenues, so that are generated by revenues and are a given percentage of revenue. So that are costs that will not exist if revenues are not generated. Here we find two possible types of variable costs. We could find more, but in this particular example we have two types that are materials and other variable costs. So we have materials costs for $148,000 and we have other variable costs for $34,000. So the first margin that we find here is the gross margin, that is the difference between total revenues and variable cost, and is equal to $154,000. Then we have other operating costs that are costs that are generated by the operation of the projects but are fixed in their nature. So what does that mean? It means that these costs exist independently of the revenues that are generated by the project. So these are costs that the firm will incur anyhow for the project independently of the size of the revenues. So here we found two typical sources of operating fixed costs. We have selling, general, and administrative costs that are also defined in synthetic way as G&A that account for $92,000 and can be, for example, the commercial costs that are sustained in order to sell the product, or the administrative costs for the employees that manage, for example, the invoicing process for this project, and so on. And then we have other fixed costs for $15,000. So if we subtract the fixed costs from the gross margin, we calculate another margin that is defined as EBITDA, that stands for earnings before interest, taxes, depreciation, and amortization, that is equal to the difference between revenues and total operating cost, but gross of depreciation, that as we'll see, is subtracted after the EBITDA. Then after the EBITDA, we subtract depreciation related to the fixed assets that have been bought for this project. And when we subtract depreciation from EBITDA, we find another margin that is the EBIT, that stands for earnings before interest and taxes, that is equal to $40,000. So the EBIT is the operating margin, that is the difference between the revenues and all the operating costs, that are the costs generated by the operations of the project. So by the production and sale of the products that are sold within this project. But we have other costs for this project, as we have seen in the previous classes, that are the financial costs and are mainly related to the payment of interest. So these costs is the operating cost affect the final result of the project in that year, and therefore affect the taxes that are paid by the firm in that year for this particular project. So if we subtract the financial costs, in this case they are assumed to be equal to $5,000, we get a pre-tax income of $35,000 on which taxation is calculated. So in this case, we are applying a 40% tax rate on pre-tax income. Applying the 40% tax rate on pre-tax income gives us income taxes for this project of $14,000, which in the end gives us a net profit after taxes of $21,000. That is equal to the pre-tax income of $35,000 minus $14,000 of income taxes. So in the end, this is the result of the project for that particular year after subtracting all the costs, including the financial cost, and also including taxation. So the second document that we find in the financial statement is the balance sheet. The balance sheet is a statement of information on the financial position of a project at a given point in time. In particular, in this example that is in the slide, we have the balance sheet at the 31st of December for a given year in the life of the project. And it's a picture of the financial position in that particular moment. So as you can see here from the example, you have two sections. One on the left is about the assets, the other is about the sources of funding or liabilities and equity. So on the left side of the balance sheet, we divide the assets depending on their short-term and long-term nature that we have already discussed in previous classes. So we find current assets and fixed assets depending whether their life is shorter or longer than 1 year. And in current assets, in this particular example, we find cash bank, so it's liquidity of the project in that particular moment, receivables of the project in that particular moment, and inventories of the project in that moment. So the total of the three items that are here gives us the total of current assets. And for fixed assets, we have plant and equipment and other fixed assets that are used for these projects. And so the total assets that we have here is $257,000. On the right side of the balance sheet, we have the sources of funding that have been used to fund these assets, and that we have already discussed in the previous classes. In particular, we find liabilities and equity. We distinguish liabilities depending on their maturity. In particular, we have current liabilities that have a maturity shorter than 1 year, and we have long-term liabilities that have maturity longer than 1 year. So in the case of current liability here, in this example, we find short-term borrowing from banks or other financial institutions, and payables that are instead towards the suppliers of raw materials and other supplies. Instead, in the long-term liability, we find long-term debt towards bank or other creditors. And in shareholders' equity, we find the equity stake of the shareholders in the project that is made by two components. One is the common stock. In this case, we are not assuming the presence of preferred stock, so we have only common stock. That is the value of the original investment made by the shareholders in this project. And we have retained earnings that instead reflects the accumulation of earnings during the life of the project that have not been distributed as dividends to the shareholders. So in the right section of the balance sheet, we find two different sources of funding: liabilities that are related to the money of creditors, and equity that instead is related to the investment of the owners. The total of liabilities plus equity is again $257. And the fact that the total of these two sections is equal is not casual, but it's due to a very precise reason, and that in the end, the assets that the project is at a given moment is to be funded by the sources of funding. So these two sections have always to weigh the same amount, because on one side you see what are the sources of funding on the project. On the other side, you see how these sources of funding have been employed to buy assets. The third type of document you find in the financial statements is the cash flow statements. So we see here that we find three possible interpretations of cash flow statements. So we have different ways in which cash flow statements can be prepared. So we can have on one side cash flow for financial planning, on the other side cash flow statements for project valuation. So cash flow for financial planning includes all the inflow and the outflow generated by a project. And it's important to understand what is the total liquidity generated by a project. So it's important to understand whether a project is financially sustainable or not, looking at all the possible sources of outflow and inflow. The cash flow statement for project valuation instead can be a bit different and typically do not include all the inflows and the outflows of the project. And what we'll see in this class is that the cash flow statements that are prepared for project valuation can be of different types. So we can have cash flow statement of total investment, cash flow statement of equity, cash flow statement for a joint venture partner. The difference between the three is the following. The cash flow statement for total investment reports all the cash flow generated by the operations of the invested capital. The cash flow to equity instead reflects the inflow and the outflow in the perspective of the shareholders that are, as we'll see, different from the cash flow that instead are related to the total investment. And the cash flow for a joint venture partner reflects the cash flow generated in the perspective of one of the partners of an eventual joint venture. And we'll see that the cash flow statements in this case will be different from the previous two. So here we'll analyze the details of each of these cash flow statements, and we'll analyze their interpretations and the reasons why the different types of cash flow statements are projected and prepared for the analysis of a project. So let's start from the first type, that is cash flow for financial planning. Here, as you can see, the document is divided into two sections that are sources of cash. So what we define as inflow, so are the positive cash flows that are generated within the life of a project. And then we have another section that is the uses of cash or outflows that instead reflects all the outflows that are generated by a project in a given year of its life. So here we are assuming also that a project has a given life of a certain number of years, and that the project requires year 0 and year 1 of construction, and then we are assuming that from year 2 the operations of the project will start. So in year 2 the project will start producing revenues and cost related to the production and sale of goods and services. So in the first 2 years, that are year 0 and year 1, we have the need to fund the investment for this project. How is this investment funded? Well, this investment is funded by shareholders and by creditors. In particular, we can see here in year 0 that shareholders have invested 400, and that the project has raised 687 of new loans. And this is because in the first year of the life of the project, is year 0, the project has to fund 1,087 of investment in fixed assets. In year 1, instead, shareholders are investing 200 more, where new loans are raised for a value of 583. At this point in year 1, we have also some other income that is generating a positive cash flow. That could be, for example, related to a subsidy. And in year 2, the operations start, so we can see that revenues are positive. They increase in year 3. So there is an inflow that is related also to the sale of products and services. And here we have also some disposal value related to the sale of some fixed asset that has been used for the construction phase and that at this point is not needed anymore. So we have an additional source of inflow. On the other side, as we can see in the lower part of this cash flow statement, this cash that has been obtained for the project is then spent to buy fixed assets in case of year 0 and year 1. Then to increase net working capital, so probably here we have some initial building of inventories. We have the financial costs related to the payment of the debt, so related to the interest payment. And then in year 2 and year 3, as the operations have started at this point, we have also operating costs that are generating additional outflows. And then we have income taxes, as here the project is producing revenues and costs, generating also positive profits. As we have seen in the income statement, these positive profits are requiring the payment of taxes. And then here you start repaying also the principal, so you have an outflow for the loan repayment. And here the project is starting paying dividends to the shareholders. And clearly, from the perspective of the project, the payment of dividends is an outflow because it's money going from the project or the firm to the shareholder, so it can be classified as an outflow. So what is important in the cash flow for financial planning, that is basically the main reason why we are preparing these documents, is that the cumulative cash flow is positive or at least equal to 0. Because this means that the project is sustainable, that the project is in equilibrium. Because if the cumulative cash flow was negative at some point, this means that the sources of cash flow will not be able to cover the needs of cash, and this will create a problem for the project because will create a financial liquidity problem in the case that the cumulative cash flow is negative. So it's important that the sources of cash flow always totally cover the cash outflows in order not to have negative cumulative cash flow. So this is the main reason why we prepare the cash flow for financial planning. And then we have the cash flow statement that instead is prepared for project evaluation. So this first cash flow statement for project evaluation refers to total investment. So in this case, we want to understand what is the cash flow that is produced by the operations without accounting for the investment made by shareholders or by external finance raised from banks and other investors. So when we are calculating the cash flow statements for project evaluation referring to total investment, as you can see here in this slide, we are excluding equity and loan from the sources of cash. And then we are excluding all the components of outflow that refer to financial costs, loan repayment, and dividends that reflects the use of the cash generated by operations, but that is referred to items that are not strictly related to the operation themselves. Here we are excluding also income taxes. They could be included depending on the different interpretation we can give of this cash flow statement, but for the moment this does not matter. So in the end, the result, that is the net cash flow, is the difference between the inflow generated by the operations, so sales from sales revenue, other income, and disposal value, and outflow generated by the operations that are referred to the increase in fixed assets, to increase in net working capital, and to the operating costs. As you can see here, the net cash flow and the cumulative cash flow that is calculated for total investment can be negative at some point in time. This means that at that point, the operations of the cash flows are generating negative cash flow. This means that the project needs some additional sources of funding that, as we saw in the previous slide, are represented by equity and loan investment. So here what we can see is that the project is generating negative cash flows from total investment in year 0 and 1. Then when the operation starts, the cash flow from total investment becomes positive, even though the cumulative cash flow is still negative at year 3. So these cash flows will be used for project evaluation using the methods that will be described in the next classes. So remember this slide, because this will be the basis for the project evaluation methods that will be described in next classes. Now we have a second possible representation of the cash flow statement for project evaluation that refers to equity and not to total investment. So the previous cash flows refer to the cash flows that were generated for total investment. That means for all the investors. Now in these slides, we'll observe instead the cash flows that are generated only for the shareholders. So the difference between this slide and the previous slide is that the cash flow statement for equity also includes external finance. So it includes eventual new loans that are raised for the project, and include also the financial costs that are generated by these loans, the loan repayment, and include also income taxes that are paid before that dividends can be distributed to the shareholders. So all these outflow that are financial costs, income taxes, and loan repayment, and inflow that are loan are relevant for equity holders. Whereas we don't consider equity and dividends that reflect the investment and the eventual payback that the equity holders will receive from this project. So what we can see here is that at the end of year 0, the net cash flow for the equity holders will be equal to minus 400. That is exactly the investment that shareholders make at the year 0, as it can be observed in the slide on the cash flow for financial planning. So we can say that in year 0, the cash flow for equity holders is negative. In year 1, we have again a negative cash flow to equity. This negative cash flow, by the way, reflects the negative investment. So the investment that equity holders have to make in order to fund the project in year 1. And that is represented in the cash flow for financial planning that has already been described. From year 2, the project starts creating positive cash flow also for shareholders. And we have a positive cash flows of 112. And the cash flow becomes even higher in the case of year 3 that generates a net cash flow for equity holders of 520, that is here. So the final representation of the cash flow statement for project evaluation refers to the position of a potential joint venture partner if the project is realized to a joint venture between different partners. So here the assumption is that the joint venture partner is invested 50% of the original equity and has a stake into the project of 50%. So this gives the joint venture partner a 50% right on the net cash flows and a 50% right on dividends. So the difference between these cash flow statements for project evaluation and the previous ones is that the previous ones refer to the project as a whole. So they were calculating the cash flow for the whole project and therefore for the whole investors or for the equity holders. In this case, we are representing the cash flow for just one partner in the case we have a joint venture. So this is the cash flow that is generated for that particular partner, and is based on the assumption that this partner has a 50% stake interest in the joint venture. So in this case, we start from the net cash flow of a project. So we assume that the net cash flow of a project is 0 in the first 2 years, and then it's equal to 102 in year 2, and is equal to 470 in year 3. Then we look at the dividends that the project is expected to distribute to all the shareholders, so not only the joint venture partner we are analyzing in this moment. So these dividends are equal to 0 in the construction phase, and are equal to 10 in year 2 and 50 in year 3. So now if you want to analyze the net cash flow of the partner, we have to account for its stake into the project, that is 50%. So the partner will be entitled to 50% of the net cash flow generated by the project. So as we can see here, clearly the net cash flow that accrued to the partner is 0 in the year 0 in year 1, because the project is not generating any net cash flow, and is equal to 51, that is 50% of 102 in year 2, and is equal to 235 in year 3, that is equal to the 50% of the total net cash flow generated by the project, that in year 3 is 470. But the partner of a joint venture has another source of inflow, that is the dividend payment. And as he has a 50% stake in the joint venture, he is also entitled to get the 50% of the dividends. So clearly in the year 1, he will get no dividends because the project is not paying any dividends to the shareholders. Whereas in year 2, he will get 5, that is the 50% of the total dividends paid by the project. And he will get 25 in year 3, that is the 50% of the total dividends paid by the project in year 3. Then the total partner inflow is represented in this line, so it's 0 for year 0 and 1. And in year 2 will be equal to 56, that is equal to the sum of the net cash flow that accrues to the joint venture partner, that is 51, and the 50% of the dividends paid by the project is 5, and so the total inflow for the joint venture partner in year 2 is 56. The same calculation is represented here for year 3. So the total inflow for the joint venture partner will be equal to the 50% of the net cash flow of the project, that is 235. Net 50% of the dividends paid by the project, that in our case is 25. And so the summation of these two components gives 260, that is the total inflow for the joint venture partner in year 3. Clearly, the joint venture partner will not have only inflows, but will have also outflows, and in particular, will have to make equity investments. As we know from the previous slides, the total equity investment required to cover the financing needs of the project is equal to 400 in year 0 and 200 in year 1. As we have said that the joint venture partner in this specific case has a 50% stake into the project, he will have to make an investment equal to the 50% of the total equity investment. So he will have to invest 200 in year 0 and 100 in year 1. In year 2 and year 3, as we saw from the previous slides, there is no projection on any equity investment because the project is able to cover the financing need to the revenues that the operation is generating from that point on. So there is no more investment, and that's why you find 0 equity investment in year 2 and in year 3. So here you find in the line joint venture partner net cash flow, the net cash flow that the project is going to generate for the partner of the joint venture, that is equal to the difference between the inflow of the joint venture partner and the investment in the equity made by the joint venture partner. So in the here at 0, this net cash flow is negative because there is no inflow and there is an equity investment of 200, so we have a negative cash flow for the equity, for the partner of the joint venture. In year 1, again, we have no inflow for the joint venture partner, and we have an additional investment of 100. So the cash flow for the joint venture partner is again negative, and is minus 100, and is equal to the investment in the equity of the project that he has to make at year 1. And instead, starting from year 2, when the operations begin, there is no more equity investment, but there is a net cash flow for the joint venture partner made by the net cash flow in the and the dividend payments. And so the net cash flow will be equal for year 2 to 56, that is the inflow, minus 0, that is investment 56. And again, also for year 3, the net cash flow for the joint venture partner will be given only by the inflow of 260, because there is no more equity investment. And here in the last line, we have the cumulative cash flow for the joint venture partner over the life of the project. We see that the cumulative cash flow is negative until year 2, because here you have minus 200 year 0, then you have an increased negative cash flow in year 1, so that cumulative cash flow passed from 200 to 300. And then the cumulative cash flow starts growing because of the positive cash flow generated from year 2 on, and so you have a negative cumulative cash flow at year 2, even though it's less negative than in year 1. And finally, in year 3, the cumulative cash flow becomes positive thanks to the inflow that the project is generating for the joint venture partner in year 3. So here we have again seen another representation of the cash flow statement for project evaluation, this time for in the perspective of a joint venture partner. So this class is ended, and as usual, I remind you that you can find additional materials about the topics analyzed in this class on the website of the course. So thank you for your attention.